Hi guys. Well, this is the very first video lecture, and we are beginning this class on chapter 14. We are going to cover chapters 14 through 24, which is the second half of the textbook, and it deals with managerial accounting, and that is, of course, the title of this course is Managerial Accounting. As opposed to 4A, which was financial accounting, and we'll go over what the differences are. But I just want to, as a preface to our review of this chapter, I just want to point out that what I do is to guide my discussion and my explanation of this chapter. I use the textbook. So what we're going to be looking at, I'm logged into Connect. I'm on the ebook. And this is what I use to review these concepts for you. I don't use the PowerPoints. I don't think they go in depth. I think they're too summarized. And then those lecture notes, they're pretty good, but actually I like to use the textbook because everything that you need to know is in the textbook. I think I mentioned in my introductory video that and if I didn't, then I'm mentioning it now, that your number one best source of information is the textbook. All quizzes, homework, and exams are author prepared. I take them right from the authors. So if it's not in the textbook, it's not going to be on any exam or quiz or homework. So then as a supplement to that source of information, are these videos that I'm making to help, to maybe just help unlock the secrets or maybe explain concepts that may not be as clear as they could be. So that's why I follow the text, because the authors, excuse me, the authors wrote this in a certain way, so I'm going to follow it in the same format that they present it. So chapter 14 we're going to spend in the real world, where we would be a face-to-face class. We would be spending about 2 weeks on this particular chapter. So I foresee breaking this down now into 3 different videos. The first one is going to cover the first section, Managerial Basics and Accounting, and I think we'll go through these first 2 sections in this first video. The second video, which I'll load in a couple days, will be on managerial reporting. No, as a matter of fact, I think I'm going to break this down into a couple. Anyway, we're going to go in order, and we'll find some decent stopping points. So let's go ahead and get started. Now, please read the chapters. You no longer have to spend time driving to class and sitting in class. So that's one good thing about this format, is that I believe that we can utilize our time a little bit more efficiently. So read the chapter. I would probably read the chapter, or at least scan it before you watch this video. Then watch the video and then go back and read the chapter again and make sure that you understand all the concepts. So let's get started. Learning objectives here, of course, yeah. And then they've got always have these introductory things. There's going to be no testing on that. Okay, let's talk about this. I'm going to blow this up just a tad, but there we go. Managerial accounting. Now, what is managerial accounting? Well, if we click on this, the definition is an area of accounting aimed mainly at serving the decision-making needs of, and here's the key, internal users, the people internal to the organization. That's why this is sometimes called management or management accounting, managerial accounting. When I took the class, it was called cost accounting. Same thing. These are this is the reporting of financial and non-financial information aimed primarily toward management. So management can make decisions about the business, beginning with, well, how much should we charge for our product? Well, I guess that depends on how much a product costs to make. And that's where managerial accounting comes in, is we track the costs of producing a product so owners and managers can make decisions like, how much should I charge for it? How many should I make? Should I discontinue a particular product and devote the resources that I'm using to make that product to make a different product? Should I produce maybe a lesser quality, more inexpensive one? These are the kind of decisions that managers need to make, and they base it on many times the dollars and cents. Can they make money on it? And so that's what the function of this area of accounting is. The purpose of managerial accounting is to provide information about three things: determining the costs that we incur to provide products and services to the general public. What does it cost me? I think that's important to know. Second, it's important for planning, and we're gonna have some chapters on budgeting, but planning, it's very important for managers of companies to plan for the future, so that way we reduce the surprises that will take place. Planning cannot be overemphasized. It's just like taking a trip. You don't just jump in a car and then start driving without having a plan of how you're going to get there and a time frame and of how long it should take, that type of thing. So we want to plan out a business just like we plan out our day. And then third is once we plan out and we come up with a budget, then as time passes, we want to compare actual results. That's called control. We want to be able to control our operations by providing information about where we currently are as far as maybe revenues compared to where we planned to be. Are we ahead or are we behind? So that way we can take possibly some steps to control and maybe make some changes to get us back on track. Planning, what does it say? Planning is the process of setting goals and preparing a plan to achieve them. So we set up a plan, and then as we progress, we control it. Process of monitoring planning decisions and evaluating how closely we are to those plans. Now, the difference between financial accounting, which was 4A, which is what we learned in 4A, and that was in fact the title of that course, versus managerial accounting, which is 4B. A lot of the information for both of these come from the same accounting system. However, they have different objectives and different constraints. So let's talk about what those are real quick. These make excellent multiple choice questions, so you want to be aware of these. Who are the users of this type of information? Well, financial accounting, the users of the information that comes out of the financial accounting system, which was, of course, the 4 financial statements: the balance sheet, statement of retained earnings, income statement, and cash flow statement. The people that are depending on those are external. That's investors, bankers, creditors, labor unions, people that are outside the organization. Many times that's the only financial information they get from the organization is financial statements. So that's what financial accounting is geared toward. The users of managerial accounting are internal. They're the managers, the employees, the people that are making decisions for the company, that work for the company. So you can imagine this is much more detailed than the financial accounting. Purpose of the information? Well, the purpose of financial accounting, of those financial statements, is to help external users make decisions as to whether they should invest in the company or not, or whether they should loan money to the company or not. The purpose of managerial accounting is to help managers make all kinds of decisions, whether we should hire more employees, make more products, slow down production. Again, what should we charge for our service or product? Flexibility of reporting. Do I have rules that I have to follow in providing this information to these people? Well, in financial accounting, yes. GAAP. Income statements have to be in a multi-step format. Goes back to chapter 5 or chapter 4, I think. We have to follow these generally accepted accounting principles. Classified balance sheet, 4 financial statements all tying into each other. But there is no constraint with regard to managerial accounting. This is information that's just being disseminated within, is that the word, disseminated? Anyway, it's being provided to internal managers. We can provide it in any format we want. It's just whatever they find useful, that's what we'll give them. So this does not leave the organization. Timeliness. Financial accounting, A lot of times it's provided only after we've completed an audit. A lot of times it's only once a year, perhaps once a quarter. But for managerial accounting, there's no audit needed, and we may want to give this information possibly on a daily basis. Managers want to know what their labor costs are, at least weekly. We don't want to wait till the end of the year to find out what my labor costs were. This is provided very quickly, and so managers can make decisions with regard to whether they're on track or not. Time dimension. For financial accounting reporting, we're historians. We're reporting historical information. Just this is how we did last year. This is how much money we made last year. There may be some predictions, but financial statements, we're not making any predictions about the future. But with the internal reporting, managerial accounting, yeah, budgets are future projections. And so there are historical information. Here's what our labor costs were last week. Here's what we expect them to be next week. Much broader time frame. Focus of the information. Financial accounting is the organization as a whole. If Walt Disney Company provides their financial statement, their income statement is for the entire company. It shows what their net income was. We don't know how much the store on the corner of Main Street, USA made versus the store over in Futureland made. We don't have that kind of information on financial statements that are given to the general public. They just know how the company did as a whole. But within the organization, is Disney, are they tracking how much every single store is making versus other stores? Oh, absolutely. You know they are. So it's and they are tracking the organization's projects, processes, products, divisions, locations, stores, everything. Much more detailed. Nature of the information. Financial accounting, those 4 financial statements, generally monetary, generally all in dollars and cents. Managerial accounting, dollars and cents, but they also have non-monetary information, such as how many units we sold, how many units we're still holding in inventory, how many customers we were able to serve. Those, we don't have that in financial statements, but managers get that kind of information. So the difference between these two is really in financial accounting, it's highly aggregated, highly summarized, provided only after the year is over, giving historical information to people external to the organization. Managerial accounting is a day-to-day process, much more detailed information to the people inside the organization in many different formats. Whatever the organization needs, whatever kind of reports that managers feel they need, that's what they get. So that's what we're going to be looking at in this class, is managerial accounting. Here's where they just talk about these different areas, which we've kind of gone over: timeliness, dimension, focus of information. Yeah. Please read through this. It's not heavy reading. Yeah. Decision making by managers. Oh, they make decisions on a daily basis. It says that although that these two do differ, they are not entirely separate. And that's true. Much of the information comes off the same system. It's really just a matter of, like for sales, the sales of an organization. Yeah, external users want to know what your sales are. Internal users want to know what those sales are as well. So there is some crossover between the information. It's just that the managerial accounting for the internal users is much more detailed. Every chapter in every accounting book always talks about fraud and ethics. The accounting profession has taken a hit over the last 20 years with organizations getting caught lying on their financial statements or foo-fooing them a little bit, and so I think that the authors of this text, along with authors of all other texts, want to make sure that we are keeping the ethical considerations of accounting in mind, because all accounting is the reporting of financial information. And I'm sure that you would agree with me that in order for that information to be useful, it has to be truthful. And in order for it to be truthful, we have to be ethical, and we cannot be committing fraud and providing inaccurate information just to bump up our sales or that type of thing. I think this was covered pretty much in detail in 4A. Yeah, fraud increases a business's costs and hurts the information. So really, systems need to set up a system of internal control, defined as the policies and procedures that are used to, what? Ensure reliable accounting. Make sure that the information that we're providing to both external and internal users is accurate. We want to be able to protect our assets. Really, that's even for ourselves. We want to protect everything we have. Companies need to protect what they have. Make sure that we uphold company policies. Policies are in place to really promote efficient operations and to protect the accounting system as well as my assets. So we want to follow those policies. And following policies, the reason those policies are there is that things run efficiently. So that's what an internal system, an internal control system does, is it helps make things run smoothly and truthfully. Careers in managerial accounting, there's not going to be no questions on this, but you can see what some of the salary levels are for these. Yeah, I'll let you review those. That's not something we probably need to know. Okay, let's go to the next section. Now, sometimes managerial accounting is called cost accounting, and and I think the reason they've changed it from cost accounting to managerial accounting is because cost accounting seems to indicate that we're only concerned with costs, not revenues. But that's not the case. We are concerned with both revenues and costs. We need to know both. So there's a trend to change the name to managerial accounting, which is what the textbook is now entitled and what this course is now entitled. But revenues are one area and costs are another. And many times, if a company is not doing well and they want to improve their bottom line, there's really only two ways to do it. Either increase the revenues or decrease the costs. And there's a lot more flexibility with the area of costs than there are revenues. Perhaps we're only selling as many as we can. Whatever product we have, for example, if we're in a donut store, the donut store that I always talk about, if I don't feel like I'm making enough money, or if I'm losing money selling donuts, and I need to somehow figure out how to make money, it may not be an option for me to increase the price of my donuts, because I'm already charging what all my competitors charge for donuts. If I increase the price, then it'll really decrease sales. So I can't increase the price of my donuts, and I might be selling as many as I can. I advertise, and I can't sell any more than this. So what's my only option? I have to figure out how to decrease the cost of producing those donuts. So this chapter, or this entire book, really, this entire area of this course is really going to be focusing on costs, these cost concepts, and how can I control the cost of producing my product? Because many times cost control is easier than revenue control. So now, in order to control these costs, I have to understand the nature of the costs and how costs react. And what the various attributes of costs are, and that's what this section is going to talk about here. Now, the first type of classification that we can define costs as are either fixed costs or variable costs, and then in a later chapter we'll see that there's some costs that have aspects of both, which are called mixed costs. But for now, let's just talk about fixed versus variable costs. Think about it in these terms. Suppose that I have I'm producing, I have a manufacturing company that produces a product, and we run 8 hours a day, 7 days a week. We just have people come in, the people that are working in the factory, and we're producing the product for 8 hours a day. Now, if we decide, gosh, the demand for our product, we find that the demand for our product has really increased. So I want to put a second shift on. Now we're going to run 16 hours a day. We're going to run 2 shifts, or even just maybe another half a shift, another 4-hour shift a day or something. But we're going to increase production. Some costs will increase as a result of that, and some costs will not increase. They'll remain the same. Now, the ones that remain the same, that will not increase, are called fixed costs. They're fixed. They don't change with levels of busyness. And probably the one that you're thinking of in your head right now, and the most common one, is maybe rent. If we rent a factory, doesn't matter how many shifts we run or how much we produce out of there, I have a fixed amount of rent that's paid every month. That's a fixed cost. Maybe my advertising budget, regardless of how much I produce, whether I run one shift or two shifts, that ad I run in the Sunday paper every Sunday it costs me the same amount. Property taxes on property I own, same thing. It's a fixed cost. It does not change with levels of activity. However, variable costs will. So what kind of costs would increase as a result of increasing my level of activity? Well, I would say probably the propane used in the forklifts. We're going to be using those forklifts twice as much. So I would expect my propane cost to go up. That's a variable cost. Utilities would maybe go up. That would be a variable cost as well. Certainly, the materials that I'm using to produce products would go up. If I'm producing donuts, if I decided to make twice as many donuts, I would expect my flour costs to double, as well as my sugar costs and whatever else goes in, my eggs, whatever goes into making donuts, the material costs. Labor. Now, some labor is fixed and some labor is variable. If we decided to run that second shift, well, of course, then the people that are working directly on the product, the additional labor that I have to hire that will be working that second shift, that's a variable cost. But how about the factory manager? Well, we only have one factory manager, and his salary is not going to go up as a result. His is a fixed cost. So that's what we just need to ask ourselves. We need to recognize that some costs are fixed. They will not change as a result of increasing or decreasing activity, and some are variable. Costs can also be classified as either direct or indirect. Now, a direct cost is a cost that can be directly traced to a particular cost object, which may be a particular product, or a particular process, or a particular department, or maybe even a customer. However I'm classifying my costs, we can trace, if a cost can be traced directly to that particular item, then it's a direct cost. If it cannot be traced to it, then it's an indirect cost. For example, perhaps I make cookies. I produce cookies, and I produce three kinds of cookies: sugar cookies, peanut butter cookies, and chocolate chip cookies. Now, chocolate chips. I have to buy chocolate chips to produce chocolate chip cookies. Is that a direct cost with relation to these cookies? And the answer is yes. It's directly traced to just the chocolate chip cookies, and it's not a cost of the peanut butter or the sugar cookies. But how about the rent on my bakery where I produce these cookies? I pay rent. Well, I can't trace that rent to just chocolate chip cookies or to just peanut butter cookies or just sugar cookies. It's not being incurred for just one of them. It's being incurred for all of them. So that's an indirect cost. That's not to say that in a later chapter we're going to allocate these costs to those cookies, but we just can't trace it directly to a particular cost object. Another way to look at it is if I decide, well, people don't like peanut butter cookies. They're just not selling. So let's not produce any more peanut butter cookies, and let's just produce more sugar and more chocolate chip cookies. Will the rent decrease as a result of not making those peanut butter cookies? No, it's going to stay the same. So it's not directly related to the peanut butter cookies. It's an indirect cost. It's a cost that's incurred. It is incurred for the benefit for more than one cost object. So another example, a grocery store. Let's suppose we have a grocery store and we have a security guard that's standing at the entrance. I live down in the Tower District, and The world's a little different down at the Tower District than it is up in North Fresno. In that when I go to my grocery store, which is Smart and Final there on the corner of Clinton and Blackstone, there's a security guard parked right at the door every day. So it just tells me it's a little different world. Now that security guard salary, that's a cost of that store, and in breaking that store down, let's look at the cost objects as being its departments. We have a produce department, we have a meat department, we have a dry goods department, we have a dairy department. Is that security guard salary? Is that cost being incurred for one of those particular departments? No, it's for the entire store. So his cost is an indirect cost, as opposed to perhaps the refrigeration system for the produce department. We have a system that actually has a refrigeration and maybe the spraying of the vegetables. Is that cost to maintain that system? Is that incurred for the direct purpose of just that produce department? And the answer is yes, it is. That's not there for the dairy department. It's not there for the meat department. It's there for that particular department. So we want to recognize whether costs are directly attributable to a particular thing or if it's a very general thing. Product versus period costs. Now this is the area where we're going to concentrate first for these next couple chapters, this chapter and the next chapter. This is the designation that we really want to get a handle on. Is a cost a product cost or is it a period cost? Now I'm going to review a little bit about accounting 4A just to give us a basis for understanding the concepts of product versus period costs. So I'm going to pause for just a second so I can go to a whiteboard. Now here's my whiteboard, a piece of paper sitting on my desk, but that's okay. So what we're looking at here is going back to accounting 4A in a manufacturing, not a manufacturing, in a merchandising environment. Remember, we had a couple chapters on inventory, chapters 4 and 5 that dealt with inventory, and then we had sales, and we had cost of goods sold. I'm not going to write it all out, but cost of goods sold. Inventory as an asset has a debit balance. Sales as a revenue has a credit balance. Cost of goods sold as an expense has a debit balance. And generally now, if we're in the business, for example, if I'm selling, maybe I'm like a Johnny Quick. And a Johnny Quick is I'm not manufacturing any of the products that I'm selling. I basically buy inventory from many different vendors. I buy potato chips and soft drinks and alcoholic beverages and the cigarettes behind the counter and some canned goods and gasoline and various things that I sell. And I'm a merchandiser. I buy from wholesalers, put it on the shelf, put it in the tanks, and then people come in and buy it. So I'm carrying inventory at a particular point in time. So that's a major cost in determining how much to sell a product for. I need to know, well, first of all, what's the stuff costing me that I'm buying, putting it in inventory? What's it costing me? And then I have to take into account all my other costs. And what are some of the other costs of running, say, a Johnny Quick? Well, I have salary expense. I have insurance expense. Good idea to get insurance. I have depreciation expense, maybe on a lot of the cash register and the counters and the shelves and that type of thing. I have advertising expense. Gosh, what are some other things? I'm kind of drawing a blank. I have repair expense. Sometimes things have to be repaired. I have maybe security expense. For an alarm system to have things monitored and have them secured. I have maybe janitorial expense. I have supplies expense because I have to clean things up periodically. And these are all expenses incurred to maintain my store. To maintain my store. So in trying to determine how much I should sell a product, my products for, and so therefore how much sales I need to generate, I need to compare that to what? How much the product is going to cost and all these other expenses that I'm going to incur. So I really need to know, what are these expenses all going to be? What are they all going to be versus my sales? And I need the sales to be more than all these costs that I'm going to incur in order for me to make money. Now, what are product versus period costs? Well, a product cost is actually the cost of the product. This is the product cost. These are the costs. These are all the costs. This is the cost of the product. And these are the period costs. These are the period costs, all of these. And they kind of make sense. This is the cost of the product itself, and these are the costs that I incur during the period of time in which I'm selling this product. For example, what was my salary expense for the month of January? What was my insurance expense for the period of January? What's the depreciation expense for that period? What was my advertising expense for the period? Repair expense for the period? These expenses all relate to the period in which it's incurred. The cost of goods sold are the cost of the product, which come out of inventory. So generally what I'm doing is I am buying, as a Johnny Quick, I'm buying products, and when I purchase them, and haven't sold them yet, when I purchase them and put them on a shelf, I put them into inventory. Remember that? Debit inventory, credit accounts payable. I show them as inventory. And if at the end of the month, if I have not sold one thing, maybe I wasn't open, I was just still stocking the shelves, I had no sales, and therefore I had no cost of sales. They're all still sitting here in inventory. But as I sell products, when I sell something, I record its sale, and then I transfer its cost over to cost of goods sold. Product costs all pass through inventory, and they sit on the shelves, and they'll sit there until I sell it. And when I sell it, then it gets transferred to cost of goods sold. That's why it's called a product cost. It's a cost of the product that was sitting in inventory. Period costs are just the costs of the period, which means that, for example, if I hire an employee and they stand behind the cash register for this week, and taking it to the extreme, they were there for 5 days. I hired them for 5 days, going to pay them for 5 days, and I didn't sell a single thing. Nobody came in to buy a single thing. Did I have any sales? No. Was there any cost of sales? No. It's still sitting over here in inventory. I purchased inventory. It's still sitting there. Did I have a salary expense this week? Yes. That was a cost of the period. These costs are associated with the period in which they're incurred. Product costs are associated with the product itself. So another way to look at that is when do product costs, when do these become an expense? This is an expense. When does it become an expense? When I buy the product? No. When I sell it. So is it possible that I could buy a product in 2020, it would sit on the shelf for 2 years until somebody buys it, and then it's sold in 2022? When is that an expense? In 2022, when I sell it. When I sell it. It's an asset sitting in inventory until I buy it. Until I sell it. And when I sell it, then it becomes a cost. That's the nature of a product cost. Period costs, doesn't matter how much I sell. These are expensed as I incur them. And that's the difference between a period and a product cost. So let's take a look back here. Product costs are the costs necessary to create, like in a manufacturing environment, to create a product. And they consist of, and we'll talk about these in just a couple minutes, direct materials, direct labor, factory overhead. You're going to get very familiar with these. as well as, and then there's period costs, which are linked to a time period and not to a product. Not to a product. Oh, looking at this kind of gives me a headache. I think we'll come back to that later after we've had a chance to look at this a little bit. So, now we've talked about costs. They can be broken up into different classifications, either fixed or variable, direct or indirect, and product or period costs. Let's go through a few of these and just see what in fact they are. Okay, they're looking at an example in this chapter of a bicycle manufacturer. They actually produce bicycles. So they're going to incur certain costs to produce bicycles. In order to make the bicycles they want to make, they're going to have to buy tires and wheels. They're going to have to pay workers to assemble the bicycles. They're going to pay for advertising. They got a production manager salary, somebody who's not actually working on bicycles, but he's in charge of production. So he's got an office upstairs and he's running the factory. Got depreciation on the office. Got depreciation on the factory itself. Oil and grease that are going into the bicycles when we produce them, manufacture them. And we have sales commissions. As commissions or as products are sold, we pay commissions. Start with the bicycle tires and wheels. Is that a fixed or variable cost? Remember, fixed or variable. If the question is, if I decide to produce twice as many bicycles, would I expect my bicycle tire and wheel costs in total to go up? Yeah, if I doubled production, I expect to double the amount of tires and wheels that I'm going to have to buy. So it is a variable cost. Is it a direct or indirect cost? Can bicycle tires and wheels be traced directly to bicycles? Yes, so it's a direct cost. Is it a product cost? Is it a cost of producing bicycles, or is it a cost of selling them? It is a cost of producing them, so it is a product cost. Wages of the assembly worker, the guy that's out there assembling bicycles. If I produce twice as many, will I have to pay workers twice as much to assemble them? Absolutely. That's a variable cost. I expect the assembly cost to double. It is a direct cost as well as a product cost as well, because these are both directly attributable to producing bicycles. How about the advertising for the sale of bicycles? It's a fixed cost. I'm not going to run twice as many ads because I want a double production. It's fixed. It is an indirect cost. I cannot trace my advertising costs to the cost of producing a bicycle. Therefore, it is a period cost. And then we won't go over all of these, but that's really how that works. I'm going to go back to our example here. Looking at the period costs versus the product costs. Another way to look at it is this way. Okay, in this course, we're talking about a manufacturer. The increased tracking that I have to maintain as a result of producing a product rather than selling it. So in this example, all I was doing is I was buying products and putting them on the shelf, and then when I sold them, I would just transfer their cost over to cost of goods sold and show the sale price. Really not too much of a logistical problem here, tracking how much a product cost. If I Michael Chevrolet, they buy a car from General Motors. I mean, all those cars that are sitting on their lots, they bought those cars. And if you went to them and said, "Look, I want to know, you've got a 2020 Chevy Silverado sitting here, and here's its VIN number." Do you think they could tell you what that truck cost them? The answer is absolutely. They're probably not going to tell a customer what it costs, but they have an invoice, and they know exactly what that truck cost them to produce. So, to buy. So here's Michael. Here's Michael Chevrolet, and they've got this truck sitting on their lot that they bought from GM. And this is the General Motors, and General Motors is the factory that produced that truck. Now, to Michael Chevrolet, they are tracking the cost of their product. Do they know what this cost? Absolutely. They can probably pick out one invoice, go find the invoice, and they can say within just a matter of, especially on the computer, within a matter of seconds what that cost them. But now General Motors, they sold that truck to Michael Chevrolet. Does General Motors know what it cost to produce? And that's for General Motors. We're talking about the exact same truck, just looking at it from a different perspective, from a different point of view. General Motors needs to know what it cost. There's so much more accounting that needs to go into it because General Motors built that truck. What went into the cost of that truck? Oh my gosh, they had to buy all the materials and all the parts that went into it. They had to buy the steel, the tires, the computer chips, the wheels, the glass, right down to the paint, to the probably the fabrics on the seats, the everything that went into it. They probably bought all of these materials, which are called raw materials, and within this factory, I'm just going to put something like this. They bought all these materials, and in this factory, on an assembly line, they put it all together to produce this truck. What did that cost? Well, it cost the raw materials. I'm going to put raw materials, RM. We're going to use that designation. All the materials, all the steel, the glass, the computer chips, the tires, the grease, everything that went into it. That was the initial cost. Then they had to pay what is called direct labor. They had to pay people on the assembly line a certain amount of money to put this all together, to come out with a truck. Now, were those the only costs of that truck? When we come out with, during a month, maybe they produced 10,000 trucks. So they have 10,000 of these trucks. And they want to know, well, what did these 10,000 trucks cost to produce? Well, we've got all the direct materials that went into all those trucks. We're accounting for those. We had to buy all that steel, all that glass, all those computer chips, all those tires. We have all the direct labor that went into those trucks, all the assembly workers that we had to pay to put those together. And were those the only costs? And the answer is no. There's another cost, which is many times the largest cost of all, and those are what are called factory overhead costs. The factory overhead. Now, what is factory overhead? Well, in order for the General Motors Company to produce these 10,000 trucks in this factory during this month, they had to buy all the materials, they had to pay all the labor, but did they incur any other costs of operating this factory? And the answer is absolutely. Oh my gosh, they had to rent this factory or buy it. They have utilities of this factory. They have insurance in this factory. They have right down to paper towels in the employee break room. Factory overhead is every cost of operating this factory except for the materials and the direct labor. It is every other cost of this factory. Let me give you another example. Maybe I have a store here. I have a store, and it's a donut store. Love my donuts, although I never eat them. Love them. They love me. I have a donut store. And what I normally, right now, I don't produce my donuts. I buy them. I buy them from a donut store over here, and I just purchase them. So when I buy them, every morning they deliver them. And so when they deliver them, I just add them to my inventory, and then when I sell them, I transfer my cost over to cost of goods sold. So all I have, it's really no problem to to track the cost of my donuts because I buy them each for a certain amount. No problem. But I decide, I could make more money if I just make them myself. So I'm going to change my operations a little bit. I'm going to open my own kitchen, my own factory, if you will. And this factory is just across the street, and nobody even really knows it's there. But this is where I'm going to produce them. So I'm going to make this my donut factory. Now, as far as customers know, they still come into my store and they buy donuts, but from my point of view, I'm making them here. This is where I'm going to make my donuts. Instead of buying them from that guy, I'm going to make them myself. And so this is my whole company. My company is made up of a donut store where I make them, I walk them across the street and put them on the shelves, and then I sell them. What are the product costs? The product costs are every cost associated with making these donuts. It's every cost that's going to arise as a result of deciding to make these donuts. So what costs am I going to incur? Well, first of all, I'm going to incur direct materials, which is going to be what? The ingredients. I don't even know if I'm spelling this right. Ingredients. Those are the direct materials. Before, I was not buying any flour or shortening or sugar or food coloring or anything. I was just buying donuts. That's all I was doing. Now I'm going to need to buy these direct materials. I'm going to have to hire some people, aren't I? I'm going to have to hire some people to come in and to roll them out and to mix them up. I'm going to hire the donut experts. This is the direct labor. These are the donut makers. Donut makers. I didn't have to hire donut. I wasn't hiring any. I had one person behind the counter here. That was it. I had one person working for me. Now I have 5 people working for me. Still got him working, selling the donuts, but I've got 4 people here now making donuts in the morning. Well, that's a product cost. That's a cost that I wasn't incurring before. This is a cost associated with producing the product. And then I've got factory overhead. What's the factory overhead? It's every other cost that I am now incurring as a result of doing this. I got to rent this place. I got to insure it. I got supplies to clean it. I got, what else? Maybe I've got security. I've got to buy pots and pans and fryers and ovens and that thing. So I've got depreciation on equipment I need to buy. I've got, every other cost incurred in this factory. Every single other cost. These are called product costs. Every one of these is a product cost. So the only thing that's changed is all the costs I'm incurring to get to this point. So how's that going to change things on my general ledger? Maybe I don't want to go there quite yet. Yeah, let me do this. Let me go back to the textbook. But now you've got an idea of what a product cost is. All of these costs are actually incurred to produce this product. The costs over here, the costs that I had before, where I had my labor, my salary expense over here, that guy's salary expense, the rent expense on this store, the insurance on this store, the security on this store, all these other expenses, these are the period costs. And why is that? It's because they are the selling and administrative expenses. These are the production expenses. Period costs, product costs. Product costs, all costs associated with producing the product. And then the selling and administrative expenses, the period costs. These expenses have nothing to do with whether I decided to produce them myself or to just buy them from somebody else. These costs are incurred as a result of selling or administering the company. Admin, sometimes known as office. Yeah, these are incurred to sell and to administer the company. It has nothing to do with production. These costs have to do with production. So, the manufacturing costs, which are the product costs, another term for manufacturing costs or product costs, are made up of direct materials, direct labor, and all the other costs associated with operating a factory, right down to the paper towels in the employee lounge. Direct labor are whatever the materials going into the product are. If I'm a pool manufacturer, it's concrete, tile, piping, all the materials that I have to purchase to produce a product. The labor is the people that are working directly on the project, the people that are actually the tile layers, the concrete layers, the pipe layers in a pool. And factory overhead are all the indirect factory costs, the costs associated with the production function. All of the indirect costs. I don't even know what I did with it now. There it is. All of the indirect costs of production. Now, factory overhead can include indirect materials and indirect labor as well. Now, what are indirect materials and indirect labor? Well, not all materials that I purchase in a factory are direct materials, which means they can't all be traced to a particular product. So, for example, if I open my factory and I'm going to if I'm going to buy propane for forklifts, well, that's a supply. That's something I'm purchasing. And I'm putting in inventory, and I'll expense it as I use it, but it's not a direct material. That propane is not becoming part of the finished product, but it's a cost I'm incurring because I'm producing a product. That is an indirect material. So a material that you cannot ultimately see in a finished product, but that is being used to produce products, is an indirect material. It's either it does not actually become part of the end product, like maybe buying sawdust to sprinkle on the floor so people who are in the factory so that our employees don't slip. Well, sawdust is not becoming part of the finished product, but it's something I'm buying and using to produce a product. That's an indirect material. It might also be, now an indirect material can also be very immaterial, very low cost items that I don't want to trace to particular products, like staples or thread. If I'm producing, say, teddy bears, maybe we have a teddy bear company. So what is the raw materials, the direct materials of produce? Well, I'll start with raw materials. What kind of materials am I going to have to produce to buy to produce teddy bears? Well, I'm going to have to buy fabric, stuffing, probably some kind of plastics to use for eyes and nose, and I'm going to have to buy thread. So now, those are all materials that are going to become part of the end product. Now, the direct materials, am I going to want to know in a particular run of maybe I'm going to make 100 teddy bears of the exact same kind, teddy bears. I'm going to want to know how much fabric was used for those teddy bears. Yeah, I'm going to track that. I'm going to keep track of exactly how much fabric I used. Am I going to want to know how much of the stuffing I used? Yes, I'm going to keep track of the stuffing. That's a material cost of teddy bears. How about the plastics, the eyes and the nose? And yes, I think I'll keep track of that as well. How much of those types of things were attached to the teddy bears? Am I going to want to measure the thread? Boy, thread's pretty inexpensive, and I don't think I'm going to measure the thread. Now, granted, it does become part of the end product. It does, but it's so immaterial. I'm going to treat it as an indirect cost. It'll become part of the cost of the product, but I'm going to treat it as an indirect material just because I don't want to measure it. I don't want to measure out how much thread was used to make these teddy bears. I do want to measure the fabric. I do want to keep track of how much batting and how much plastics were used for a particular batch. I don't want to measure the thread. Likewise, if I'm making tables, I will keep track of how much wood how much glass went into it, perhaps how much metal went to it. I'm not going to measure the glue. Granted, the glue does become part of the end product, but it's so immaterial. I'm going to treat it as an indirect cost. Factory overhead is all indirect costs, and small materials we're going to treat as indirect. Indirect labor is labor that is incurred in the factory, but is incurred, but cannot be traced to particular products. Now, there's indirect labor and direct labor. Direct labor is the cost of those people working directly on the assembly line. If I decide I'm going to produce, I don't know, let's produce tables. We're going to produce tables. So I hire carpenters and people to work on the machines. What I pay people that are actually converting wood and glass and metal into tables, that cost is direct materials, is direct labor. Those are direct costs of producing tables. Is there any other labor that I'm paying in the factory, anybody else I'm paying that isn't working on the product? And the answer is yeah. Security guards, they are maybe working at night. They are a cost of the factory. If I open a factory, I may have to hire a security guard and that he's a labor cost to keep the place secure at night. Is he direct labor? Is he working on the product? No, he's not. How about janitors, people that come in at night and clean up? Well, they are a cost of the factory. If I didn't open a factory, I wouldn't have to hire a janitor to clean it. But he is an indirect labor. Still, a product cost is a cost of the factory, but it's not direct labor. How about the factory supervisor? Well, the factory supervisor, he's not down there working on the factory or working on the product, but he is a payroll cost. He is a labor cost of the factory, but he's not working on the product itself. So there are indirect labor costs, and as an indirect cost, it's factory overhead. So let's look at these again. We have direct materials, those materials that can be traced directly to the end product. We have direct labor, those labor costs of people that are working directly on producing the product. And then we have factory overhead, all indirect costs, every single indirect cost of the factory, including indirect materials and indirect labor. These are all indirect costs. Every cost of the factory can be classified as either direct materials, direct labor, or this large catch-all, indirect costs. Non-manufacturing costs, costs incurred by my company not associated with manufacturing, those are period costs. Those are the selling and administrative expenses. Non-manufacturing costs, they get expensed in the period they're incurred. They don't become part of the cost of the inventory. We're going to see the journal entries in the next chapter, maybe even a little bit at the end of this chapter. Prime and conversion costs. Let's talk about what the prime and conversion costs are real quick. I'm going to go back up here. Prime costs are sometimes referred to as direct costs. These are the prime costs, direct materials and direct labor. Those are the prime costs because these are the costs that I can see in the end product. When a table is finished, I can tell you exactly what the cost of the wood cost and exactly what the people that worked on the table, how much that cost as well. These are the costs that are directly attributable to that table. Factory overhead are indirect costs. I can't tell you how much rent should be charged to that table. So that's an indirect cost. So these are the prime or direct costs. And direct labor and factory overhead are called conversion costs because these are the costs that I need to incur to convert, hence conversion, to convert raw materials into a finished product. I have a pile of wood sitting here, pile of wood. I want to convert it into a beautiful table. What cost do I have to incur to do that? I have to incur direct labor, and I have to give them an environment. I have to provide an environment in which the direct labor can work. That's going to cost rent, utilities, insurance, security, paper towels, it's all these other costs. These are the costs that I incur to convert raw materials into a finished product. So these are your direct or prime costs. These are your conversion costs. We'll see how that works. Yeah. How far down are we? I think that for right now, I think I'm going to end it there because we're right now at an hour. So I think that we should take some time to get used to these concepts and these definitions a little bit. And the next video will pick up, we'll review this a little bit, and we'll pick up from there looking at the cost flows as they flow through the balance sheet and onto the income statement. So with that, just start reading through this chapter, get through this section, and we'll pick it up from there.